Okay, good afternoon, folks. It's a pleasure to be here. Lots of faces we haven't seen for quite a while. It's great to be on the stage with two guys that I've known for many years. Barry and I used to work together, and I must say I wasn't that envious of him hearing that he's talking about ESG and the like in the South African context, because it's often we feel like we've only got 50 or 60 shares to invest in, and bringing it down to 15 becomes a bit challenging. But I think he's given you some proper insight as to how that's possible. And Shane, likewise, I think we've been on these panels many, many times. I must say the other day I went into ESG and perhaps onto ChatGPT and asked it probably vainly about myself. And it said that I died in 2019, but I was also very surprised and proud to hear that I was also on the board of Investec, Alan Gray, and the Cape Philharmonic Orchestra. For those of you who know me, that's just not possible. So we're sitting in South Africa with the lights going off the whole time, and if you're frozen with fear, don't worry, because you'll defrost, because there's no electricity. The reality of where we sit, I was sitting with a big client of ours yesterday who's a farmer, and the ramifications of what's happening on the electricity front, I think probably aren't fully understood by all of us. He was explaining to me if we get into stage 8, 9, 10 load shedding, he can't feed his cows, the shops won't have maize in, there's some scare stories, and we always like to see the glass half full, but I think we need to be very cognizant of the risks that are out there. And I think the one thing about the electricity scenario is that it certainly continued to surprise on the downside. So should you invest in SA equities? I think and we're talking about viewing the SA equity market in a global context. That's our topic for today. I think in reality, if we get a private client with 50 million rand coming to us and saying they want 50 million rand of equities, we'll probably put around 15 in the SA market and 35 in global markets. And that's ultimately the litmus test of how one feels. There's a massive difference, and the SA market can't even really be compared to talk about SA versus global. I don't think is even a meaningful comparison, and I'll go through that. But ultimately, there are some really good companies with really good people in South Africa, quite idiosyncratic. A lot of businesses invested and listed in South Africa for historic reasons that have no particular reason to be here. So let's go through the basics. First of all, just quickly, our business, we started in 2012. We've got about 110 billion rand of assets under management. It's split roughly 55% local and 45% offshore. And we're looking after the generational fortunes of many South Africans and servicing lots of South African advisors. I think from a product point of view, I sit here, we have an SA equity fund. We have a lot of fun in there. We're very passionate about SA equities with the business's size. We've got a large investment team, 20 full-time investment professionals looking at asset classes all over the country. So we've got an SA equity fund, which we started quite recently, about 2 years ago, because people like the building block approach. We also have another equity fund which has international in it. And then, obviously some global funds. I think our Anchor Global Equity Fund won the 3-year Raging Bull a few months ago. So we've got the full suite of investment products. So there's no particular agenda to favor SA equities or not. But the reality is, there's times when it's much better to be in SA equities versus the globe as a whole. We also don't view the globe as a whole. There's obviously, 6,000 shares and lots of different themes and opportunities. But from an SA point of view, it was a great place to be last year versus global equities, and it might well be again this year. It doesn't kind of feel like it at the moment, but one never knows how things play out. I think what's important to understand is the difference. If you're investing in a world index versus SA, you're buying West versus East or developed versus emerging. SA, about 60% of the shares of the revenue on the SA market has its fortunes tied to China rather than South Africa, and certainly a lot more than the rest of the world. The local market is dramatically cheaper, about half the price to global markets. There's a lot of shares in South Africa that are probably caught in a value trap, but those 4, 5, 6 PE multiple shares, there will be things that unlock them. We follow all of those closely, and if you can be there when that's unlocked, that's when you get 40, 50, 60% returns. SA growth is a lot slower than the rest of the world. It's hard to imagine that South African GDP growth is going to be a lot higher than 1% over the course of the next few years, constrained dramatically by load shedding and the like. But every set of difficulties creates opportunities and different investment perspectives. So, Barry's run through ESG, and that is an opportunity. As we, we kind of staying quite far away from SA Inc. companies that are being impacted by load shedding. But when that turns, and turns it will, it's a bumpy road, but when the private sector is allowed to enter the room, spend some capital, invest, and create capacity, it will change. Although frustratingly, the results of that we'll probably only see in about 18 months' time. But when that changes, the fortunes of South African companies directionally will be very, very exciting. So at our investment meeting this morning, before I came here today, our retail analyst was talking about Pick and Pay. There you've got a company which runs at very low operating margins. So a big increase in any of its costs is very significant in the business. So it's about a 2 to 3 billion rand operating income business. Ironically, I also got reminded today, Pick and Pay hasn't grown its earnings per share for the course of the last 9 years. It's actually been a terrible business. But that aside, their fuel cost is somewhere between 600 and 800 million rand on additional diesel cost. It's an operating profit of 2 to 3 billion. So when that comes out of the system, the share price at 38 rand, which we ain't touching, has got potential to get to 60 rand. So I guess what I'm saying, in any set of circumstances, there's opportunity. Then choice. It's kind of random that we've got British American Tobacco and Richemont and Naspers. If you want to buy a tech share, do you just want Naspers as opposed to the 20 others we look at and invest in globally? If you want to own a tobacco company, is it specifically going to be British American Tobacco? And likewise with Richemont. And then the rand dynamic, which I'm not going to talk too much about. But I think very importantly, the way we think about investments and looking at investment futures and forgetting about benchmarks and quarterly performance for the moment, we certainly think in the world reached a third inflection point in 2 decades. 1995 was Netscape and the internet, 2000 was the iPhone, and we think 2023 will be remembered as the inflection point of artificial intelligence. And you want to be on the right side of that from an investment perspective. You want to not be invested in businesses that are going to be negatively impacted. We're currently seeing a phenomenon in global markets where if anybody says AI will impact them negatively, the share price is down 40% in 3 minutes. But you want to have exposure to the companies that will benefit from that accelerating change. So having said all of that, you can see how dramatically different South Africa is to the globe. And I haven't gone through the normal stats of the makeup of our market, which I think everybody's well aware of. But there's always opportunity in our market, and there's some great businesses. So we like retaining capital here. When people have got SA expenses, we like to have some SA shares to kind of match it up. So looking at what one should expect from different asset classes around the world over reasonable time periods, stocks, which I've circled there, you should expect a 10% per annum US dollar return out of shares. And that's kind of 8% earnings growth in the States plus a 2% divvy. And SA should give you that kind of 10%, maybe a little bit more, but in rands, that's going to lag a bit behind. So SA, we don't see as I think because GDP growth is a lot lower, we don't see as a buy and hold of the big companies. You have to be a lot more tactical. As Shane was indicating, this year you had to be in the gold shares. So there's always places to make money in the SA market, but I think it has got more difficult, and the fund managers need to be pretty alert. I think another point is, we're largely driven by China. And you can see on this chart the GDP growth in China, the second biggest economy in the world, is pretty much the only place there's going to be growth in the world. So that's one of the reasons to be fairly positive about emerging markets. It's actually where the growth is for the next year or two. Thereafter, we think the US will bounce back quite strongly. But you need to be diversified. You need to have exposure to where the growth is coming from in the world. And China, we're not that excited about buying shares in China, but SA is certainly a derivative of that. The median valuations, if you look at the 1-year forward PEs there, you range from 17 times for the MSCI World Index, 19 times for the S&P X Energy, whereas SA comes in at about a 10 PE multiple. It's difficult and hazardous to use the average of the SA market. You've obviously got some quite highly priced shares, which are the global ones. Resources, PE multiples can be deceiving. But then at the bottom end, and a lot of the stuff that Barry has made a lot of money out of, Some really great businesses in SA sitting at 5-6 PE multiples. And if you can find the inflection points for those businesses, there's nice money to be made. You do want to invest globally. I think our default is to have more than 50% of one's money in global markets. And you've got to look at where the R&D is being spent. Japan, US, China, Germany. And there's a lot of people spending a lot of money inventing the future. I looked the other day, South Africa's GDP is about $350 billion. The turnover of Amazon is $500 billion. The R&D of Amazon is $78 billion a year. So, there's a lot of people spending the money on inventing the future, and you certainly want to have some exposure to that. This chart just shows, innovation is getting quicker and quicker. AI, robots, drones, clean tech, and there are derivative ways to play that in SA. For example, as Barry talked about copper and investing in the companies that require transmission metals. It only took 5 days for ChatGPT to reach 1 million viewers. It took a lot of the other entities out there a few years. So speed is accelerating. I think there's reason to be quite fearful of it. But from an investment point of view, one wants to be on the right side of that as well. The big issue in South Africa is you've got all the global stuff. About 40% of our companies or 40% of our market cap is impacted by load shedding. A very busy RMB chart here. But if you focus on what I've put in the red blocks there, at the moment, the government Eskom is supplying about 24,000 megawatts. And we think within 3 or 4 years, the private sector will be supplying 26,000 megawatts. So, the deficit will get erased. Banks will lend about R1 trillion over the course of the next few years in order to do that. That presents a massive opportunity and makes our banks look pretty attractive at the valuations that they're trading at. So that's kind of our summary of how we see SA versus the globe. We bottom-up investors. There's lots of opportunities we like. There's some great management teams here. Our top 10 holdings in South Africa are not that different to many other big investors out there because of the size of our markets. Below that, we've got some quite interesting plays that we think have got some nice upside potential. But I think a theme to look at in our top 10 holdings is probably only 30% exposure to the SA Inc. world, and that's largely through the big banks. So we think the SA market this year will give a reasonable return. We think there's big kickers to come through as the negatives of load shedding become positives, but that's probably only kind of 9 to 12 months out. So we remain active and interested in SA equities. One needs to be invested globally, but I guess that's the message as a whole. Thanks.
Okay, so just from myself here in London, Dan, if you just want to pop onto the first slide so I can chat to it. So I'm Liam Hechter. I sit in London. I work for Anchor Capital and the Hedge Fund here in London. I'm a South African born and educated, Stellenbosch University chartered accountant, and I moved here about 5 years ago. Also a CFA, so very much the South African cookie cutter finance professional. I've been running the hedge funds at Anchor since 2017. And in terms of the strategy, we have one strategy, but really 3 access points to it. So the Anchor Stable Fund, which we took over back in 2021, where I took over the management with my colleague here, Damon Hoff, back in 2021. It's a fund that's been around since 2003. It used to be called the Pollard Stable Hedge Fund, and Damon started it back in 2003, and we're back on running that since 2021, so the last two and a bit years now. That's basically a carve out of the broader strategy South African portfolios, and then the fund that I started running back in 2017, which was really the Anchor Accelerator Hedge Fund, which was a fund that was my sort of stepping stone into the world of becoming a portfolio manager on the hedge fund. So I've been doing that for, what feels like a lifetime now, but it's about 6 years. So the outcomes on the fund since inception, or since at least our inception, has been quite good for us. And the strategy's got about R1 billion invested across those 3 different access points, one of which I'm not allowed talking about because it's not registered in South Africa. In terms of the difference between the two, between Anchor and Accelerator, stable and Accelerator, it's basically stable. It's just really limited to what we do on the JSE, and Accelerator, we include a broader investment universe, and we also trade stocks outside of South Africa in that portfolio, pretty much close to 50-50 in terms of net equity exposure. And just in terms of that stable fund, I mean, it really is run with a very similar mindset to what Sai was talking about earlier, in terms of much more of an absolute return type of mindset. Within Anchor, we've got obviously a lot of different products, and this one is more designed around fits somewhere between our sort of flexible income funds and our balanced funds. So it takes somewhere between 20 and 50% net long equity risk. Pretty simple type of investment strategy, fundamental long short equities, and that really just is a complementary product within the Anchor broader equity offering. And since inception, it has done, or since at least the inception that we would count in 2021, has delivered a really good outcome for us, taking relatively low equity risk. And I think what I'll touch on later in my presentation is that I think the JSE is quite suited to hedge funds, and I think the environment going forward is going to be even more so. So if we could, I guess I wanted to just touch on those points, just because it leads into the sort of meat of what I'm going to be presenting on. In terms of my subject is more looking at South Africa and looking at markets through a different lens, or the lens of a hedge fund manager. Obviously, we concede that in general markets go up, and it would pay in an environment when markets only go up to just be 100% net long, maybe even geared long into that. But for a hedge fund manager, we certainly view life very differently. So we don't look necessarily at performance without looking at how much risk you've taken to deliver that performance. So at the end of the year, being up in a long only portfolio just because the market's up and you've captured basically the market is probably a good outcome, or being down and you're better than the market is also a good outcome. I guess in the mindset of a hedge fund manager, you're only going to really make money if your clients have made money, because a hedge fund manager is really incentivized to generate a performance fee. So our whole sort of philosophy and this like absolute return mindset is more around making money and trying to avoid capital losses. And in terms of us measuring how well we've done, we measure our performance largely as a function of how much risk we've taken. So in terms of that, it should sort of take that mindset of being a hedge fund manager relative to, or different to, a long only manager who's really after a relative performance. Ours is much more needing to make money, and that kind of brings us into the discussion of looking at South Africa through the lens of a hedge fund manager. I probably should have said that the title of the slide should probably have been looking at the JSE through the lens of a 35-year-old hedge fund manager who wasn't really there for the good years, because I, as a PM that kind of started my life in this journey at the age of, in 2017, I really haven't been given many sort of freebies in terms of the market just going up. I've really had to work for our returns, and that's really instilled a bit of a discipline in terms of the process, in terms of as ratings kind of peaked out in South Africa and growth started slowing, it really became an environment that I think really suited hedge fund from probably the time that Cyril took over as president in South Africa, where there was a lot of optimism around the recovery and growth in South Africa. You kind of were in an environment where South Africa still possessed this premium to the rest of emerging markets, and growth expectations were really high. And I think that it provided this opportunity for a couple of years, from certainly the 2018-19 and probably bottomed out in early 2020, where you had this big derating and the premium that South Africa traded at to the rest of the world and emerging markets specifically eroded. And I think that if some portfolios were able to take advantage of the really good years, particularly on the long side, leading up to that period, all of a sudden there were these these bombs going off everywhere, and what looked like probably to us what seemed like more of a value trap scenario. So, to the point, I think that if you're looking at South Africa and you go back to that environment where returns are much harder to come by, growth is clearly deteriorating in South Africa at a clip. I think that environment is probably going to throw up more opportunities for managers or hedge fund managers on the JSE if they're playing that sort of absolute return type game, using all the tools at our disposal. I think the one that we use outside of long short equities is probably, or that we use quite often, is options. So it allows us to try and achieve an outcome which is the same outcome but with a very different risk profile to if we were just taking a pure long portfolio. So I guess that kind of sets the tone for how we as managers look at managing long short portfolios on the JSE. In South Africa, cash rates are really high. So where you were in an environment in the US where managers needed to really use equities as the only place where they could get a return. I think in South Africa, that environment's quite different. Getting a real return almost on taking zero duration in the market seems like quite an attractive equation. And in the next slide, you'll see exactly how tough it's been for guys who started generally when I started. So that lighter blue line is essentially STEFI or a benchmark that we try and outperform each year. When I was doing this chart the other day, I was actually quite amazed to see that STEFI and the Cap Swiss have done very similar type of returns. Obviously, when you're looking at it through the lens of a hedge fund manager who wants to analyze the return of something relative to the risk that you're taking, the outcome for STEFI seems to be just a hell of a lot better than if you were taking a lot of equity risk along the way there. That sort of muddle along scenario for equities up until the crash of 2020, that's the type of scenario that I would say suits hedge funds the most. Muddle along, really tough operating environment. I would say that the ramp up in equities that you saw from those real crash lows in 2020 till the end of 2021, I would say that I wouldn't say that those are perfect for a hedge fund unless you got a very wide risk tolerance. I would say that that's more of a market that would probably have suited long only portfolios more. But I guess the question that you would then need to ask yourself as an allocator, as an investor, and I better behave myself because one of my biggest investors is sitting on that panel there, is what's the environment going to be like going forward? I mean, we all know the scenario in South Africa. I mean, obviously you don't want to hear that from me sitting in London, but I mean, in terms of the investment opportunities, we've been very disappointed with the deterioration in the domestics at an operating level this year. But at the same time, obviously valuations in South Africa are really cheap, so it makes short selling maybe a little bit tricky. But I'll touch on that in a few more slides. So I guess the value proposition for a hedge fund manager like us becomes far more pronounced in an environment that's a lot tougher. In a rampant bull market, I would say that it probably makes it harder for us to justify what we do when you're running gross exposure of 100 but nets between 20 and 50. It makes it very hard to keep up with the rampant bull market. Our returns over the last couple of years, we can't really complain about in South Africa. I think we've done exceptionally well. I would say that it probably needs to moderate a bit in terms of how well we've done. But I think an environment that would suit us and suit the relevance of our product is probably a much tougher environment going forward for investors on the JSE. In terms of the next slide, I think these conversations are always good if you hear from the hedge fund managers just what they're thinking. And I think when I was doing this slide, I felt quite good about the fact that I wrote down there that it's okay to admit that the current backdrop is making building high conviction portfolios quite tough at the moment. Look, I think it's one of the perks of being a hedge fund manager is that my default allocation is how much I can earn on cash, which at the moment is offering me what I would consider a real return in both dollars and in rands. That's a good outcome for the level of risk that's out there at the moment. I think Sai touched on a lot of those risk factors, but in terms of the way we're looking at it, we think that there's a lot of conflicting information out there globally. I think that the bond markets are telling you that they're adamant that there's a recession around the corner. The Fed seems to be very focused on a very narrow set of data points, which is quite confusing to us. I think to us at least, it seems highly likely that inflation is going to fall quite quickly towards the back end of this year, and the S&P is pricing in a scenario where analysts are way too low on their earnings, and it just seems like something's mismatched over there. And then you've got a scenario where positioning globally is about as bearish as we've ever seen it. Since at least I've been around. We look across, Goldman Sachs, our prime broker, sends us a lot of data across the global hedge fund industry in terms of what exposure people are running, and we basically back to the lowest net exposure to equities and that we've seen, other than the sort of March 2020 absolute lows, which I think you almost want to strip out in terms of, because that was just a much quicker bear market. And in terms of the recovery in China, it certainly looks like that's on the go, and it's something that we consider is probably the most interesting investment case around at the moment, but it seems not necessarily very good for the JSE, as opposed to how the recovery is playing out. It seems far more consumption and services led than something that's going to really push the commodity market. So, bringing all that back to the JSE, after a period of strong outperformance for like 2 years, I think it's worth noting that the JSE was a standout market for 2 years, and I think that the factors that really drove the JSE over those 2 years could unfortunately become, or at least could turn on them. So that sort of value-driven markets, big commodity exporter, and a low exposure to the stuff that got really whacked when interest rates went from 0 to 5% in a very short space of time in the States, where like that high growth, high beta, long duration stuff. So I think that the JSE was really well placed for those 2 years, but unfortunately, what we're seeing is maybe some of those factors seem to be reversing. And the two big bellwethers there being China and the Fed. I think if China really stimulates on the investment side and you get commodity demand, then yes, that will be very good for the JSE. But it seems as though interest rates getting cut in the US because growth is coming off is probably, the JSE doesn't really have the mix that's going to really be suited to that kind of a market. So, in those types of scenarios, we quite cognizant of the factors that drove the JSE for the last 2 years, the outperformance maybe turning on it going into the back end of this year. So, our exposure to the JSE is about as low as it's been. Somewhere at that low end of what we're allowed to trade, so 20-25% net long. We do have quite a lot of gross exposure, but I would say that very different to what we had in the scenario from 2018 to 2020, where there was actually a nice bit of multiple compression that needed to happen. The JSE is trading at very cheap levels, and we don't want to be compounding risk in our portfolio by trying to short the lows on a lot of these stocks. So basically, playing it very cautious in terms of the types of exposures we're running. And as soon as we get this set up, we'll probably deploy more capital into those markets to generate the types of returns that we're looking to get.